Welcome to this session on options trading, where we will be discussing how to use options to hedge your portfolio or generate income. Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a specific date. Options are used to manage risk and generate income. In this session, we will cover the basics of options trading, the different types of options, and how you can use options to hedge your portfolio or generate income. Part 1. Basics of options trading. Options are derivatives, which means their value is derived from the value of an underlying asset, such as stocks, bonds, or commodities. There are two types of options, calls and puts. A call option gives the buyer the right to buy an underlying asset at a specific price, while a put option gives the buyer the right to sell an underlying asset at a specific price. When you buy an option, you pay a premium, which is the price of the option. The premium is determined by the market and is influenced by factors such as the price of the underlying asset, the time remaining until expiration, and the volatility of the market. Options trading can be complex, and it is important to understand the risks and rewards before getting started. It is also important to have a trading plan and risk management strategy in place. Part 2. Using options to hedge your portfolio. Options can be used to hedge your portfolio, which means protecting it against potential losses. Hedging is a risk management strategy that involves taking an offsetting position in a related security. For example, if you own a portfolio of stocks and are concerned about a market downturn, you could buy put options on an index that tracks the stock market. If the market does indeed decline, the value of your put options will increase, offsetting the losses in your portfolio. Another hedging strategy is to use covered calls. This involves selling call options on stocks that you already own. If the price of the stock remains below the strike price of the call option, you keep the premium in the stock. If the price of the stock rises above the strike price, you will be obligated to sell the stock at the strike price, but you still keep the premium. Part 3. Using options to generate income. Options can also be used to generate income. This involves selling options, which can be risky, but can also be profitable. One strategy is to sell covered calls on stocks that you own. This involves selling call options on stocks that you already own. If the price of the stock remains below the strike price of the call option, you keep the premium in the stock. If the price of the stock rises above the strike price, you will be obligated to sell the stock at the strike price, but you still keep the premium. Another strategy is to sell cash-secured puts. This involves selling put options on a stock that you would be willing to own at a lower price. If the stock price remains above the strike price of the put option, you keep the premium. If the stock price falls below the strike price, you will be obligated to buy the stock at the strike price, but you still keep the premium. Part 4. Risks and rewards of options trading. Options trading can be profitable, but it is also risky. It is important to understand the risks and rewards before getting started. The rewards of options trading include the potential for high returns and the ability to use leverage to amplify your profits. The risks of options trading include the potential for high losses, the complexity of options trading, and the risk of buying options that expire.